Welcome to Taking Stock, Empower's first thoughts on leading financial news. I'm Vanessa Welch, Vice President for Financial Insights, and I'm here with Empower's Chief Investment Strategist, Marta Norton. Today, we're discussing the September Consumer Price Index results. The data was just released, and it did come in hotter than expected, signaling rising inflation. This unexpected uptick reveals consumers faced increased costs during the past month, and this could impact the Fed's next move. Marta, good morning to you.
Good morning.
Should we be worried? What's your take here?
Well, we never want to see higher prices, particularly when that's a burden that consumers have been bearing for a few years at this point. I would suggest that while we've seen kind of an uptick in various areas across goods and services over this past month, that this doesn't necessarily upend the narrative that we've seen longer term of a trend of cooling inflation. And there is some good news to point out in this report. We'll discuss it, but when we take a look at shelter, we actually saw shelter contribute a bit less to this inflation report than in prior months. And of course, that's been a sticky area of inflation. So it's nice to see continued moderation.
Yeah, so it sounds like no major cause for alarm here. Considering core inflation excludes food and energy, Marta, what do you think is driving this increase?
Right. So to your point, core inflation is stripping out food prices, it's stripping out energy prices, and it's left with core goods and core services. And when we take a look at core services, shelter makes up a meaningful portion of that, both rent and owner's equivalent rent, which is what an owner would get if the owner were to rent out his or her place. Now, when we take a look at what's happening within the housing market, economists are tracking real-time rents, and this gives us an on-the-ground feel for what housing prices look like. And actually, those real-time rents have come down meaningfully over time. And that would suggest that actually housing costs are coming down. However, we haven't seen that really translate into these indexes as rents kind of, turn over on a slower basis. And so with that translation and that lag, changing the timing and changing expectations, it's made these shelter costs look a bit stickier than maybe they are in reality. But the on the ground readings aren't changing. So we would expect that translation to occur in time.
So, Marta, how do you think this might affect the Federal Reserve's thinking as they get ready for their next meeting in November?
Yeah, so a bit of recap for recent history there. The Federal Reserve kicked off its cutting cycle in September. And with that cutting cycle, it started things off with a half percentage point cut, or a 50 basis point cut, as you might hear investors refer to it. This was really significant. The Federal Reserve doesn't typically engage a cutting cycle or start a cutting cycle with a large move like that. And it really shows how closely the Fed was watching the labor market. But we did get the minutes out of that meeting recently, and we saw that there was a lot of debate around the size of that cut. With this inflation report, I think there's a stronger argument for a more moderate pace, and the Fed has said a more moderate pace is its base case anyway. So I think this report really confirms the idea that we could see a quarter percentage point cut in November.
Yeah, it will be interesting to see for sure how they balance things, Marta. Let's switch gears a little bit now and talk about Hurricane Milton. It has caused significant disruptions, significant damage. It's just devastating. Millions of people right now without power. So many of us have friends and family there, and we are thinking about all of them right now. But as we also think about the economic impact, Marta, I'm curious if you think that it will have an impact in terms of supply chains and costs for consumers.
Right. So, of course, Vanessa, echoing the concern there for what people are experiencing in real time in Florida today and in the days to come. When we look at natural disasters, they're never a good thing from an economic standpoint. So, taking a look, for example, at something like Hurricane Katrina, what we saw was devastation, of course, in the wake of the hurricane, and that lowers output, and then over time a rebuild, and that raises output back to previous or sometimes even above previous levels. When we take a look at Florida, it's a populous state. It contributes meaningfully to the U.S. economy. It does have a port in Miami, the 10th largest port in the country. But of course, there's a lot of other access points on the West Coast and on the East Coast. So I don't know if it's necessarily going to snarl supply chains on its own, but it's certainly the type of event that can weigh on the economy. Now, I would suggest that the U.S. economy is very resilient at a national level. So I don't think this is necessarily changing that narrative, but it's not a pleasant thing to watch, and it is on the margin a negative for the economy.
Great insights as always, Marta Norton, Chief Investment Strategist for Empower. Thank you so much for your time this morning. It's definitely clear that we have some challenges ahead with rising inflation and those external factors like Hurricane Milton. We know that you'll be monitoring that for us. And we want to thank all of you for joining us for Taking Stock as well. Have a great rest of the week.